Understanding trend lines is essential for effective trading, as they facilitate the visualization of market direction and the identification of potential breakout opportunities. This fundamental tool plays a critical role in technical analysis. When drawing trend lines, linking multiple touchpoints significantly enhances their reliability. A more accurate trend line effectively mirrors market sentiment and prevailing trends. Traders should prioritize adjusting trend lines to conform to the overarching price movements rather than striving for exact precision. Trend lines denote zones of support and resistance, thereby aiding in the decision-making process. A comprehensive understanding of trend lines aids in recognizing potential market movements. For instance, a breakout below an uptrend line may signify a potential downward shift in market direction. Backtesting indicates that while trend line breakouts exhibit a reasonable success rate, relying exclusively on them may not suffice. It becomes imperative to incorporate additional tools to enhance accuracy. Volume indicators augment trading strategies by offering insights into market activity. When high volume coincides with price movements, it denotes strong buying or selling pressure. High volume during price increases signifies bullish trends, whereas high volume during price declines suggests bearish trends. This interplay between volume and price action is critical for traders' analyses. The synthesis of trend line breakouts with volume indicators greatly enhances trading strategies. This combined approach validates breakouts, thereby enabling informed trading decisions. The MACD indicator serves as a robust tool for confirming bullish and bearish signals. Comprising three components, it assists traders in identifying potential market movements. A thorough understanding of MACD crossovers is vital, as they denote bullish or bearish momentum. This insight allows traders to effectively anticipate shifts in the marketplace. Integrating MACD with trend line breakouts yields improved trading outcomes. This methodology guarantees that traders engage with confirmed market movements, rather than acting on mere speculation. Volume analysis stands as a pivotal element in validating breakout signals. An uptick in volume corroborates the strength of a price movement, thus guiding traders' decisions. The MACD crossover serves as a significant indicator, reflecting whether institutional investors are entering the market, which can substantiate trading decisions. Integrating volume analysis is indispensable for confirming breakouts, as it reflects robust buying or selling pressure that effectively supports market movements. An understanding of how to analyze different time frames enables traders to execute trades with precision and to mitigate conflicting signals arising from various charts. Utilizing the hourly chart assists in pinpointing clear support and resistance levels, thereby guiding traders in making informed decisions regarding potential market movements. This approach is crucial for effective trading. Implementing a risk-reward strategy is vital. By establishing stop-loss orders and targeting profits at twice the risk, traders ensure a disciplined approach. This strategy maximizes potential gains while minimizing losses. Recognizing liquidity sweeps on higher time frames can signal market reversals, providing crucial information for traders. This knowledge assists in confirming trade setups and predicting market direction.